Hi everyone, welcome back to my channel. This is lesson 9. Don't wait to buy real estate and wait. So, you now know that you need to live beneath your means. Your gazins must always be more than your gazouts. Once you have your lifestyle under control, once you have your financial house in order, it's time to buy guns. In your younger years, avoid the urge to buy butter. Okay, here's the thing. If you want to get wealthy, you're going to have to invest in something. You ain't going to get rich saving your money in a bank account. And you definitely ain't going to get rich if you're always buying butter items. To gain wealth, you have to invest in guns. But what guns should you buy? Let me tell you, there are many ways to get wealthy. My way is just a way. It's not the only way. But my way has created more millionaires than any other investment vehicle. So that's the way I'm teaching. Once again, I didn't make this stuff up. I was taught this by many very successful people over the past 31 years. And I'm just passing on the information to you. My way is acquire wealth by buying real estate. It's really, really simple. Just buy real estate and hang on to it for 20 or more years. The more real estate that you own, the wealthier you will be. If you own just 5 properties, odds are that with appreciation and principal pay down of your loans, you'll have a net worth of over $1 million after 20 years. Now here is the real beauty of owning real estate that separates it from most other investments. You are allowed to leverage into the investment. That means that you can put a small amount of your own money as a down payment, borrow the rest, and then control the whole entire value of the property with just your small down payment. As an example, let's say you decide to take the plunge and say goodbye to renting and you buy your very first owner-occupied home. If you bought a $200,000 home and you qualified for an FHA loan, by the way, FHA stands for Federal Housing Administration, you would only be required to put 3.5% of the purchase price as a down payment. That's only $7,000. For your $7,000 investment, you're now controlling a $200,000 asset. If property values rise 5% in the first year, your home is now worth $210,000. If you hung on to that property for 20 years, it's entirely possible that its value could have doubled. That means for your initial $7,000 investment, you now have a property that is worth $400,000. And that's just if you control only one property. If you didn't buy that first property and continued to rent, how much would you have? And if instead you invested that $7,000 in a stock and say that stock even quadrupled over 20 years, that stock would only be worth $28,000. This is why owning real estate with the ability to leverage into the property is so incredible. But before you start frantically calling a realtor so they can help you buy 10 or 20 homes within the next month, which is a lot of what the free seminars preach you should do, there are many things to consider. First of all, you have to be realistic. And part of being realistic is understanding that you have to come up with the down payment money to buy real estate. And you also have to qualify for a mortgage loan. How much down payment money you can save and how much of a home you can qualify for is based on your income and expenses. Now, if you've followed what I've taught in my previous lessons, you will have stayed in school and graduated from some fine university with a degree in a field that pays a nice annual income. If you didn't do that, then hopefully you studied to enter the trades or some other well-paying field, such as plumbing, electrician, welder, mechanic, legal secretary, etc., which also pays a nice annual income. Now, if you didn't do that, then you've limited yourself to a lower paying job. You can still get wealthy through owning real estate if you have a lower paying job. It'll just take longer and you might have to take a little bit of a different avenue. I'll explain that later in an upcoming video. Next, you must totally subscribe to avoiding to buy butter items. You should be living well beneath your means. You should pay off all credit lines and close all but the most important credit cards that you have. You should be able to entirely pay off your credit card bill each month. Do not charge a purchase to your credit card unless you pay it off that month. That way, you're never paying any credit card interest. You're using the credit card company's money for free that month. Your credit card statements must show a perfect payment record and zero balances each month. This is crucial. Also, avoid paying monthly payments on butter items. This is also extremely crucial. Unless you win the lottery or inherit a fortune from someone, you will need to get a loan or mortgage to buy real estate. Some people call this OPM, which stands for other people's money. In most instances, this OPM is from a bank or lending institution. When you go to apply for a loan to purchase real estate, the bank will use the following rough calculations to see how much of a loan you can qualify for. Here's how they do it. How much will I qualify for? Well, the first thing they do is they take your gross monthly income before taxes, and you would plug in that figure there. Step 2 is they take 40% of that figure, so times 0.40. Step 3 is when you times your gross monthly income before taxes times the 40%, that equals gross qualifying income. Now here's the big thing that affects it so much. Step 4 is minus long-term monthly debts longer than 10 months in duration. This would be like a car payment, boat payment, motorcycle, whatever, credit card payments. And so you have this figure here, but you minus your long-term monthly debts longer than 10 months in duration. And that finally equals step 5, equals the maximum house payment that you can afford. And that includes principal, interest, taxes, insurance, and if there's any homeowners association. So principal, interest, taxes, and insurance is typically called PITI. So that's how they do it. Let's do a couple of examples to show what I'm talking about. This first example, this fellow's name is Graham Guns. Yeah, that's his name, Graham Guns. He's a young fellow in his mid-20s, and he has a used car that's very reliable, totally paid for. He lives very much beneath his means, and he's just very financially responsible. He has no debts of any kind, and let's say that Graham, his gross monthly income before taxes is $6,000. So let's qualify Graham for a loan. So first of all, we take his $6,000 and then we times that times 40%. That equals his gross qualifying income of $2,400. But from that figure, remember, you have to minus long-term monthly debts that are longer than 10 months in duration, such as a car payment, boat payment, motorcycle, credit cards, etc. Oh wait, Graham's smart. He has 0 monthly debts. His car's paid for. It's not a brand new BMW or Mercedes, but boy, it's reliable and it's paid for. So he has no long-term monthly debts, so he doesn't have to minus anything. So that equals his maximum house payment that he will qualify for, which is $2,400 minus 0 is $2,400, including principal, interest, taxes, insurance, and homeowners association, if any. $2,400 in many parts of the country can buy Graham a pretty nice entry-level home or condo. So in this instance, I'm going to say, way to go, Graham. Now let's do a little different example. This time, this other young fellow named Bobby Butter, yes, that's his name, Bobby Butter, also earns the same $6,000 per month. But he has a bad habit of buying butter items on credit. He bought himself a shiny new Mercedes-Benz on credit. The monthly payment for his new wheels is $500 per month. Bobby Butter also recently bought a Harley-Davidson motorcycle on credit. He really needed it because he and his buddies go riding each weekend. The monthly payment on the Harley is $200 per month. Of course, with the new Mercedes and Harley, you need new duds, right? Of course you do. Bobby bought 2 new leather outfits for when he's riding the Harley and 3 new Hugo Boss suits so he could look successful when driving the Benz. he charged those clothes and some other stuff on his credit cards. Bobby's credit card payments are $200 per month. Oh yeah, I forgot to mention that Bobby had gone to an expensive college and got a degree in Greek mythology. After 4 years of upper education, he had amassed $100,000 in student loan debt. His monthly payment for the student loans is $1,000 per month. By the way, Bobby Butter works in an office now. That Greek mythology thing never really offered much in the way of jobs. Okay, so let's see what Bobby Butter qualifies for now. As you can see, he makes the same gross monthly income as Graham Guns did, $6,000 per month. You take 40% of that figure times 0.40, and that equals his gross qualifying income of $2,400 per month. At this point, he's in the same position as Graham Guns. But wait. From that figure there, you have to minus long-term monthly debts longer than 10 months in duration. You have to minus the Mercedes-Benz payment, $500 per month. You have to minus the Harley-Davidson payment, $200 per month. You have to minus the credit card payment for his clothes and other stuff that he charged, $200 per month. And you have to minus the student loans payment, which is $1,000 per month. That equals a whopping maximum house payment of $500 per month, including principal, interest, taxes, insurance, and homeowners dues, if any, that Bobby Butter can qualify for. With this scenario, Bobby will not be buying real estate anytime soon. But boy, he sure appears to be successful, doesn't he? In fact, if people were to look at both Graham Guns and Bobby Butter, on the surface, it would appear that Bobby Butter is way more successful than Graham Guns, when the truth is the exact opposite. The true reality for Bobby Butter is that he's probably either living in a roommate type situation or living at home with his parents. In this instance here, I'm going to have to say, poor Bobby. As you can see, a person can make a good wage, but if he or she is burdened with too many monthly consumer debt payments, it could limit, if not completely eliminate, the possibility of qualifying for a loan to buy a home. This is why it is crucial to avoid monthly payments on butter items. Before we move on, I want to discuss a couple other things. First of all, it's very important for you to have this figure here, your gross qualifying income, equals maximum house payment. You do not want any long-term monthly debts. That way, your gross qualifying income will be the same as your maximum house payment. This figure here, this $2,400 here, after they calculate your debts, is what's called your back-end ratio. And this back-end ratio, in this instance, represents 40% of your gross monthly income. But I want to share with you, this 40% figure that the banks use to qualify, that's not a set in concrete figure. Let me give you an example. There are different lenders out there, and some lenders are conservative, some lenders are moderate, and some lenders are very aggressive. We use the 40% figure, and in my opinion, that's moderate and that's just right. And I think you'll find that most lenders that are in the game of lending mortgage money are using that 40 to maybe 43% figure. There are lenders out there where they'll go, oh, no, we don't want to use 40%. We want to use 30% or up to 35%. I would not use those lenders. They are too frugal. You can see instead of $6,000 times 30%, they'd only qualify you for up to $1,800 a month payment. Or if they go 35%, it's only up to $2,100 payment. And that's being too conservative with the tax breaks that you get from owning real estate. On the flip side of it, you can have a lender that's too aggressive, and they are out there, and they will lend anywhere up from 45 to 50% of your gross monthly income. So you could see $6,000 times 45%, all of a sudden they'll qualify you up to $2,700 a month, or even $6,000 times 50%, they'll qualify you for up to $3,000 a month for your house payment, including principal, interest, taxes, insurance, and homeowners dues, if any. But you do not want that, because that will equal payment poor. I used to tell my clients, it's one thing to say, look at my lovely home, but it's another thing to go out to a nice dinner once in a while or go on a vacation or whatever. If you're spending 50% of your gross earned income on a house payment, you will be payment poor and your life will suck. Lender 1, which is conservative, I don't think you need to do that either. I think lender 2, 40% to maybe 42, 43% is just right. You know, you could see $6,000 times 40% is $2,400. 6,000 times 43% is up to $2,580. So the other thing that I used to tell my clients is, it's wonderful that a lender will qualify you up to here or even here, but ultimately you're the one who's going to be cutting the mortgage payment each month. So it's flattering that maybe a lender will say, oh, we trust you that you'll be able to make payments up to that amount, but you're the one cutting the check. So you say, well, you know what? I definitely don't want this. And, you know, 43% is too high for me too. I want to stay 40%. Or maybe you're just really, really conservative yourself and you go, hey, you know what? I just want to get it down to 35%. I don't want to exceed $2,100 for a monthly payment. And there's, you know, that's not wrong to do that. I think it's definitely wrong if you start pushing up here. But anyways, that's just what I wanted to share with you. There's no set figure, but for you to qualify, I think you need to be between 40 to maybe push yourself to 42, 43% of your gross monthly income for your house payment. Now we can move on. The other extremely important ingredient in the quest for qualifying for a home loan is that you must have excellent credit. The better you pay your bills on time, the higher your FICO credit score will be. The highest credit scores allow the borrower to get A paper money, which is at the lowest interest rate. Marginal credit scores get B paper money, where the interest rates are higher. And low credit scores either disqualify the borrower from being able to qualify for a loan, or the rates are so high it doesn't make sense to purchase the home. Your goal is to qualify for the A paper money. You do that by always paying your bills on time, having zero balances on your credit cards, and having minimal lines of credit. As I mentioned before, I always pay off my credit card balances each month, and I only have 2 credit cards. One of those credit cards gets me free air miles with American Airlines, and the other card also gives me award points. In all of the time that I've had those 2 credit cards, probably over 20 years, I don't think I've paid the credit card companies any interest at all. Now, I'm sure that they like that I always pay my bills on time, but they're sure not making any money off of me. Resist the urge to open new lines of credit. You know, it can be flattering that all these companies are telling you that they think that you're a great credit risk. Many will even offer a gift or money incentive if you sign up for one of their credit cards. But realize that every new credit line that you open, your FICO credit score goes down. That can hurt you when you go to qualify for a home loan. Personally, I feel a couple of credit cards are okay, but I would not recommend many more than that. Okay, now that you live beneath your means and you have zero balances on your very few lines of credit and your credit score is in the A paper range, your financial house is in order. It's time to buy your first property. You have reached a very important step in your life. It's time to start building wealth. Now, here's what you have to do. You must now do some very serious research to find this next person who will be instrumental in your path to wealth. This very important person is your real estate agent. But it is crucial that you just don't call any real estate agent. Remember that the 80% theory also applies to real estate agents. You want to pick someone who is a full-time, experienced professional, someone in the top 20% of the field. This top-notch real estate agent must also have this very important qualification. he or she must already own their own home and rental property. Believe it or not, the real estate industry has many agents who don't own their own homes. They're in the business of selling homes, yet they themselves continue to rent. How can you sell something if you don't believe in your product enough to buy it yourself? In my opinion, avoid these agents. There are also many agents who own their own homes, but they don't own any rental property. In my opinion, these agents are qualified to sell homes to clients who will occupy the home, but if they don't own rental property, they either don't understand or don't believe how owning rental property is a great way to acquire wealth. Avoid these agents also. Now, I'm not saying these agents are bad agents. They could be awesome agents, but in the area where they have chosen to specialize, which is selling homes to owner-occupied clients. You want this ultimate experienced real estate agent who believes 100% in the product. This agent must own their own home and ideally at least 2 other rental properties. If they happen to do property management for their own and other clients' properties, that's a definite added bonus too. Find this real estate agent and tell him or her your goals, and then be totally faithful to him or her. I have made not only myself very wealthy by owning real estate, but also I have made numerous clients wealthy as well by helping them find awesome real estate deals. Now, you might ask, why would I pass awesome real estate deals on to clients and not just buy them all myself? Well, you can't buy them all. Of course, I would cherry pick and take the most incredible deals for myself, but sometimes I just wouldn't be ready to buy another incredible deal. So that deal goes to my most cherished clients. You want to be one of those cherished clients. Let your agent know that you will be totally faithful and you want him or her to make you wealthy through buying real estate. Believe me, they can do it. Also, never grind your real estate agent for a reduction in their commission. The top agents earn every cent and they can make you a lot of money. As an example, if an agent has an incredible deal on a property that hasn't hit the market, also known as a pocket listing, and that agent has the choice between 2 clients as to which one gets it. If one client is always asking for the agent to discount the commission and the other client never asks for a discount, you can bet that the client who never asks for the discount will get the call. Be faithful to your agent and never grind him or her on the commission. Your real estate agent will have put in the thousands of hours honing his or her craft. This highly skilled professional agent will be the one who understands GRMs, GSIs, cap rates, NOI, ROI, depreciation, recapture, expense ratios, tax benefits, and the oh so important real estate cycle. I'll be teaching you about the real estate cycle in an upcoming video. Knowing the real estate cycle can make you a fortune, and not knowing the real estate cycle can put you in bankruptcy or foreclosure. But let's go back to talking about the real estate agent that you need. This top-notch agent will know all the top plumbers, electricians, handymen, and other tradespeople who are honest and do repairs for a reasonable price. This real estate expert will be with you every step of your way and always be a phone call away to answer all of your questions. And for this ultimate source of knowledge, it costs you nothing. That's right. You don't pay your agent when you buy. The seller pays the commission. So, if it doesn't cost you anything to tap into this incredible source of knowledge, why would you ever want to try and do it on your own? Why would you want to spend 1,000 hours to learn about the real estate craft when you can have that top-notch real estate agent working for you right now at no cost to you? Now, I'm not saying that you shouldn't learn about investing in real estate. You definitely should. But what I'm saying is that instead of you trying to do it on your own, you can tap into the knowledge of this awesome realtor that you're going to find, and your journey will be much quicker. To give you an example of how important it is to find this awesome real estate agent, I have to tell you about Helmut, my son-in-law. When he was dating my daughter, Nicole, she was going through real estate school to get her real estate license. I was tutoring Nicole, and Helmut took an interest in the business, so I began tutoring him as well. Both Helmut and Nicole got their real estate licenses. Helmut was 19 years old when he got his license. Nicole is a little bit older than Helmut, and she got her license when she was 20 years old. I spent the next 2 years teaching them the stuff that brilliant people were kind enough to teach me. 4 years later, Helmut is 23 years old. He's now a real estate broker running his own company, and Nicole is a licensed property manager working with my wife Connie. He and Nicole are married, and they have their own home plus 3 rental properties. Their net worth is close to $500,000. Did I mention that he's only 23 years old and Nicole is 24 years old? If you know what you're doing, it can happen that quickly. I'm one of those incredible, awesome real estate agents, and they tapped into my knowledge and gained major wealth very quickly. So, how do you find that special agent? If it were me, first I would look at online review sites such as Yelp. I would probably also ask people who own a lot of property which realtor they use. Word of mouth recommendations can be very useful. But once again, be sure the agent already owns their own home and also owns at least 2 other rental properties and knows about property management. These are definite must-have qualifications. If the agent has been around for a long time, has a great reputation, and not only sells to owner-occupied clients, but also sells a lot to investors, and either manages property himself or herself, or has a great relationship with a reputable property management company, that agent is probably a good choice. A quick test might be to ask that agent what the average GRMs are for the area. If the agent doesn't know what you're talking about, you don't want him or her. We'll be talking about what GRM means in a later lesson. Well, that's all for lesson 9. Don't wait to buy real estate and wait. I'm really hoping that you're enjoying my courses, and if you are, please subscribe and please smash the like button and please smash the notification bell. Also, you could help me out by telling your friends about my channel and getting them to subscribe too. Thanks much, and until next time, bye-bye.